Hello everyone, I'm David Darst, here to give you a quick recap of the month of August. Starting with inflation, it was uppermost in investors' minds and financial markets. You had the core consumer price index up 3.1% in month of July versus 2.7% in June. Producer price index even more, and you know that's going to be feeding into the consumer price index later. Producer price index on a headline basis up 3.3% versus 2.3%. So this was beginning to be unsettled, and of course the personal consumption expenditures number that came out on the very last day of the month. You had also these inflation expectations. The New York Fed and the Michigan Consumer Sentiment Surveys, both of them give you investors and financial markets expectations of inflation 1 year ahead for August, 4.9%, and that's a big jump from July's number, 4.5%. The New York Fed's version of this, 3.1% for the 1 year versus 3.0%. So you see inflation expectations have been building there. This all leads the Fed, you had at the July 29th and July 30th meeting, two of the Fed voting governors wanted to cut. Two of them elected actually to reduce policy interest rates by 25 basis points. As of now, for the September 16th, 17th meeting, you have right now financial futures markets are giving an 85% chance of a 25 basis point cut and 15% of zero change to the 425 to 450 monetary policy interest rate range right now. The next meeting is October 28th, 29th, and then you have December 9th and December 10th. It's our version our opinion and our version of events that you'll probably get at least one more cut after a cut in September. So two cuts between now and year end, maybe three. Chair Powell gave a speech in Jackson Hole, Wyoming. He said that basically risks for inflation are tilted to the upside. Risks to employment are tilted to the downside. You remember the last 3 months jobs growth has averaged only 35,000 a month. That compares to 180,000 a month throughout the year, the whole of the past 2024. He basically, in his words, he said an adjustment to the monetary policy stance may be appropriate. And that's where basically you saw interest rates start to come down. You see the 2-year Treasury during the month. It closed at 362 during the month. It was down 32 basis points, and so far this year, it's down 63 basis points. All of this is predicated and driven by expectations of the Fed getting more into an easing mode. They've been in a restrictive mode, getting into an easing mode. So we're down 63 basis points versus the 425 for the 2-year that it started this year. The 10-year started this year at 458. And it closed the month at 422, and that was down 15 basis points for the month, and it's down 36 basis points thus far this year. That's not gone down as much, and that is indicative in our thinking to the risks that perhaps easing may actually lead to inflation expectations being high because of the fiscal stimulus, and because of the stickiness and the tariffs situation. The Standard & Poor's 500 for the month of August was up 2.6%. It's up 10.5% thus far this year. And this is after big months in May, June, and July. May, it was up 6.2%, June 5%, July 2.2%. And then August on top of that. Europe is up 13%, and don't forget the euro is up another 12.9% itself against the U.S. dollar. So in dollar terms, you're up over 20% in European equities. China, 14% gain thus far this year, and it was up, the renminbi is up 2% against the dollar. So you're basically getting help there. Japan up 7% for the stock market, and the currency versus the dollar, the yen, is up another 7%. So you're in mid-teens in your performance. I want to point out the bank stocks. Where we've had always more than a passing interest, we've had a specialization and a focus there. The bank stocks up 18.3% year to date. The Russell 2000 had a big month in August. That's your small and mid cap stocks. That may indicate that the market's broadening out here. Up 7.5% for the month of August. It's up 6.6% year to date. Gold up 4.2% in August, and it's up 30.5% year to date to 34.31.80. And oil, there have been supply concerns, too much supply of oil relative to the demand picture. Oil for the month down 6.7%, and thus far this year, oil is down 9.9% year to date. The dollar down 7.5% year to date. Volatility started a month ago. You may recall it was 16.73. It closed the month at 14.42 at month end. So you saw, again, almost similar in the bond markets. Interest rates going down, volatility going down here. The positioning that leads us to this would be diversification, okay? Some value, some growth, some defensive positioning, okay? And then as far as asset classes, you want to have some meaningful exposure to private equity, private credit, and private real estate. Private equity is giving you historical outperformance. It is giving you access to these wonderful, unique, growing companies that really are available in the private equity markets that are not there in the listed markets to the same degree. You remember several years ago, 10, 15 years ago, you had 8,000 listed companies. Today, you're down to 4,000 listed companies. And you've got 20,000 or more private equity companies that are able to be brought public or sold to strategic buyers. Private credit, there you have risk-adjusted attractive yields. If you are careful with the credits and positioning in the capital structure, you can gather and gain and earn some very nice yields there. You have strong downside protection when you're having, if you have good protection on the yields. And then private real estate, there, as we've talked before, you really want focus on data centers, multifamily. Selectivity is very key. We see that as an excellent inflation hedge, and you're having low correlation with public markets. With that, we wish you all a great month ahead and look forward to catching up with you very soon.